My name is Andrew Petwain and I am the editor of insuranceinvestor.com. Today I am joined by Chris Palmer, head of Illiquid Assets Origination at Phoenix Group. Hello, Chris. How are you?
Hey, morning. How are you doing?
Good. Very well, thank you. So Chris will be joining us at our Private Markets Investor 2023 event in London in March. He'll be speaking on a panel discussion about which asset classes and investment structures represent the best investment opportunity. So a big, broad topic there with lots to discuss. So Chris, I'm going to dive straight into my first question with you. So to start us off broadly, which asset class and investment areas are the best opportunity for return in 2023 and why?
Okay, good question. I'd probably say three off the bat. Firstly, anything that brings me inflation-linked cash flows. We're an insurance company. Pretty much all of our liabilities are inflation-linked. So if we can get inflation-linked income, it matches nicely. So the kind of things that bring us inflation are anything to do with ground rents or leases, to do with property, and also some of the banks have lots of inflation risk they don't want, so that we can take it off the banks. So the inflation, number one. Number two, probably anything that's not in sterling. We've seen some good value recently, and we expect that to continue for 23 in non-sterling trades, where we cross currency back into sterling for our liability matching. The euro area has been particularly valuable. The basis is in our favour, so that's a really good hunting patch for us. And probably finally, I'd say transactions where we can do the whole deal or do the whole deal with one partner, where we can control the terms, the structure, and fit it to our balance sheet rather than do a generally syndicated deal where we just get told what we're getting and it's usually rubbish. So big deals, anything with inflation, anything non-sterling.
There's a lot to discuss there. So building on that, with the current economic conditions, what do you see as the most pressing challenges for the private market investment community?
Do your credit work properly. You can't really trade out of this stuff in any economic way. So once you're in, and that might be in for 20, 30, 40 years. So you've got to do your credit work properly. Where's the supplier to this business? What's its manufacturing process? What's its dependency on energy for its function, its exposure to energy costs, its exposure to people? Wage inflation's gone through the roof. So proper fundamental credit analysis. It's actually a really good time for anybody who's a credit analyst, where that work, that insight is really valued to keep us away from defaults. It doesn't matter what the spread is if you don't get par back at the end. Fundamental credit work, number one.
Perfect. So my next question is sort of along that line as well. So we're filming this at the end of 2022. We're going to be going into 2023. Are there any surprising areas that will see growth or decline due to the current economic climate and the way things are working in the world?
I think everyone's going to look at renewable energy. The terrible things in the Ukraine, energy security, and the cost of energy affecting all businesses and all people. But we have a slight nervousness about renewables because so many people want to be invested in renewable energy and green things that for borrowers, it's a great time to borrow. But for investors, it's really an awful time to invest because you get these incredibly leveraged, incredibly flaky structures that are really not investment grade quality, but someone on the with the right lens and the right wind says it's BBB minus, maybe it's an absolute push, and then it prices like a single A. So you're absolutely not being rewarded for the risks you're taking. So I just suggest a bit of caution, a bit of reality around renewable investing.
And to finish us off, so the current world, we've discussed the legislation, we've discussed the economic climate. Let's focus on the legislation. What effect is that legislation having on the asset classes, and which ones are doing well and which ones are doing poorly because of this climate?
I think that some of the Solvency II reviews that are being talked about, and yes, no, we haven't seen the exact detail yet, and we all need to think about that with our actuarial colleagues really carefully. But I think Solvency II review will be a great benefit to us. Removing the risk margin is long overdue. I'm slightly nervous about the removal of the cliff edge between investment grade and sub-investment grade, because there's two ways of making that cliff edge less painful. You can make it more painful to invest in triple Bs or less painful to invest in double Bs, but detail, please. And just outside the UK for a bit, if the US government administration ever agrees with itself, which is a massive if, there is an enormous opportunity for US infrastructure, And it's a third world country, right? The trains, the airports, the underground system is pretty shabby, and there's a huge need for public and private capital in the US, and we'd love to play an active part in that, and we are waiting for them to actually put those shovels in the ground.
There's a lot to discuss there, and obviously the US infrastructure bill would be huge for the market if it did pass. So thank you very much for your time today, Chris. It's been very, very interesting hearing you. If you're interested in what Chris was saying, he will be speaking, as I mentioned, at our Private Markets Investment Group conference in March in London. There are full details of the agenda and the other speakers at clearpathanalysis.com. So I'd like to thank Chris for his time today, and I'd like to thank you very much for watching, and I'll see you again soon.
Andrew, take care.